First tonight, Rio Tinto. And there were always likely to be big numbers from the big miner. But how about these? Record earnings of $7.6 billion for the past 6 months, underlying earnings of $13.5 billion and an extension of the share buyback. Well, our chief reporter, Andrew Robertson's been taking a look and joins me now in the studio. And frankly, Andrew, it looks like Rio is absolutely rolling in cash.
Well, it is. Sales, as you've noted, soared. Commodity prices were the driver of that. They added the rising commodity prices added nearly $5 billion to the result. Sales just under $30 billion, which is more than $1 billion a week. And in the biggest division, iron ore, sales jumped 40% to $13 billion as iron ore passed $100 a tonne. Now, it wasn't all plain sailing. The fall in the US dollar wiped nearly $800 million off Rio's profit. Also on the negative side, earnings in the energy division were down 40% and costs overall blew out by more than $1 billion, which means as impressive as this result was, it slightly missed analysts' forecasts.
But as we've noticed, the increase in the share buyback was a bit of a surprise. Is that an indication that Rio really has more money than it knows what to do with at the moment?
Well, it is. In February, when Rio announced its full-year result, it also announced a $5 billion share buyback, which it was hoping to complete by the end of next year. But with the money flooding in the door, it's already completed 2/3 of that. And the company is struggling to find investments with an acceptable rate of return, which is something that Chief Financial Officer Guy Elliott alluded to.
The first thing that we want to do with surplus cash is to invest it in high-quality projects. And within the constraints of having a prudent balance sheet and a progressive dividend policy, if we then find that we've got surplus cash, then it's our job to return it to the shareholders. But that is not the first priority, because the first priority is growth.
Now, on the issue of returning cash to shareholders, Rio is lifting its interim dividend by 1% in Australian dollar terms to nearly 50 cents a share.
Now, amid all the good news, of course, there is growing concern that Rio is too highly leveraged to both iron ore, but also to China.
Well, that's right. Rio earns about 70% of its profit from iron ore, and by far the biggest customer is China, which on its own delivers about 30% of Rio's earnings. And as one analyst said to me tonight, that's fine at the moment, but if the price of iron ore should fall and or if China should have a hard landing, Rio Tinto could be in a very dangerous place. And this analyst also said to me, with Rio's heavy reliance on iron ore, it's a bit of a misnomer for the company to describe itself as a diversified miner. Now, Rio Chief Executive Tom Albanese does recognise that there are risks for Rio Tinto with all the uncertainty out there in the global economy at the moment, but he remains confident that that heavy reliance on iron ore will continue to pay off.
What a very big Australian.
Our
Andrew Robertson,
longer-term picture remains absolutely intact, and as I've said before, we expect that over the next 15 to 20 years, consumption trends will lead to a doubling in demand for iron ore, copper, aluminum, and certainly other commodities.
And tonight in early trading in London, Rio Tinto shares are down about 2.5%.
Andrew, thank you very much for joining us tonight.
Thanks, Nick.